Good morning, everyone. Welcome to this update for global markets and the Australian market for the 19th of July. And much calmer week last week than what we've seen as events around Greece and China certainly settled down. So let's have a look at the week as it proceeded. So some degree of market calm was restored. First of all, the Chinese economy and the Chinese stock market. Look, I don't know. I don't speak to many people that actually believe these Chinese GDP numbers. They came out through the week very conveniently, right on target at 7%. And the fact that they can get them out within just a couple of weeks of the end of a period also makes them a little bit unbelievable. So, we can just take them for what they're worth. But look, they certainly gave markets a bit of a sense of calm where people thought that the Chinese economy might have been about to get into serious difficulty. As far as the Chinese stock market goes, the Shanghai Composite Index, it's the most contrived stock market in the world. It's just absolutely ridiculous, and I don't know how it's going to play out. I suspect that the government will keep supporting it for a lengthy period of time, but in all the years I've been in the market, I've never found once yet that governments could sustain a market indefinitely when the fundamentals are poor. So I think eventually we'll see the Chinese stock market make its way lower, but it doesn't really correlate very well with global markets anyway, so it may not be an issue. Now, a deal was done with Greece, of course, and whichever way that deal went was going to be disastrous for the Greek population, who are the real losers out of all this. But it really did reveal that the Eurozone as a concept and the Euro as a central currency has just got some severe long-term issues. And for that reason, I don't think we're going to see stability there for a long time to come until something quite dramatic changes. And certainly Germany has got a few of the other countries offside, in particular with France. So I can see continued disruption in the Eurozone for years to come. Yet despite that, markets rebounded very hard and they're back close to all-time highs, which just leaves you scratching your head, quite frankly. But that's certainly a lot about the fact that the ECB is just hosing markets with an extraordinary level of excess money. So I'm expecting interest rates to remain close to zero and a heavy level of stimulus from the ECB for at least 5 years and could be significantly longer. So we can expect to see European markets do reasonably well under that scenario. Now, looking at the American stocks, the S&P 500 index was up by 50 points on the week. So that was quite a sharp gain, and it's back to almost all-time highs. Earnings season has just started. There is an expectation that across the board earnings will decrease by 4.5% in earnings per share terms. Now, a good part of that is due to energy, so the oil stocks. Take them out, and the forecast is actually probably for some mild growth. But nevertheless, with such modest earnings expectations, we're finding that a very high proportion of companies are recording an earnings beat. And that's always good for the market because the market prices where they expect earnings to be. And if earnings do better than that, even though they might be, essentially flat, then the price tends to get ratcheted up a little bit. Let's just look quickly at the Aussie situation. The Aussie dollar remains in a downtrend, broke support as I indicated last week. And the ASX 200 had a good week for a change, and it actually broke a downtrend channel, as we'll see. So it was up 178 points on the week. But unlike America and Europe, we're nowhere near recent highs. And even though we broke a medium-term downtrend channel, I think there's a very good chance that we're still just forming a base rather than a new uptrend. And part of the reason that I say that is there's been an absolute avalanche of profit warnings coming through in the last month or so, and even one in healthcare with primary healthcare during the week. So that's really bad signs for the Australian market. Let's take a look now at at the indices, and we'll look first of all at the S&P. So you can see a very sharp decline around the fears about Europe and China, and then an equally fast rebound. And we've seen this story before. It's been playing out this way now for about the last 3 or 4 years, and really nothing has changed. And the American economy is moving ahead slowly. There's still a strong air of uh, disbelief about how things are going. I think people are still fearful and negative, and they're the kind of conditions where stock markets can just continue to grind higher. Now, looking at the broader picture, let's look at the monthly chart that we take a look at each month, and you can see it started to just lose a little bit of momentum, but really finished the month off very solidly. So that was a pretty positive sign. Let's just look at the internals in the American market. This is the NASDAQ index. Had an absolute screamer of a week and surged to new all-time highs. As you can see, that was a really, really powerful week in the NASDAQ, and we've got Apple reporting their quarterly earnings on Tuesday night, so that'll be a real indicator for the market as well. And we'll just check the broader small cap Russell 2000. Not quite at all-time highs, but quite close to it. So things looking pretty robust there. Just having a look at the currencies quickly. This is the US dollar index. So you can see he's had a pretty strong couple of weeks as the euro has settled back down again. So that rally in the euro is looks like it's come to a completion. And if we just look at the Aussie dollar, you can see there we had support here at about 75.5 cents. We broke through that 2 weeks ago, and we've done absolutely nothing to rebound from that level. So we've got to go back a long way, and you can see the next significant support comes in here around just under 73 cents. And then you're then starting to get down into the low 60s. So if 73 cents breaks convincingly, then I think we're looking at mid to low 60s. Now, it might take 6 months or a year for that to play out, but I think that's certainly the trend of where the Australian dollar is heading. Now, moving on to commodities. Gold has broken support, was down by $31 on the week, and it's the lowest close in 6 years since 2009. So that's the depths of the GFC. So it's looking particularly bad for gold. And the gold stock indices recorded new lows. So looks particularly dodgy there. Let's just have a look at the gold chart. And I meant to look at the Aussie index as well. So this is the ASX 200. You can see if we pan back, we're still miles below our pre-GFC high. We did break some important resistance, but have struggled ever since and have gone back into that prior trading zone. You can see there was a pretty well-defined downtrend occurring, which really started up around about mid-April. We had a strong week, so we managed to break that downtrend. But you could also argue that we're not necessarily into a new uptrend. This could just be a case of forming a big up and down consolidation zone in that area there. So I wouldn't get too excited about the Australian market. And when I look at the fundamentals, when I look at the profit warnings coming through, when I look at the valuations of the banks, I look at the problems in commodities, I really can't see for the life of me how we're going to make a decent crack at breaking 6,000 points. Now, turning to the gold market, I'll just look at the weekly, just the bigger picture. So we've had this declining wedge pattern, which has been threatening to break for some time, and you can see that really finally occurred. That was the support area there. We broke through it. During the week, we closed right on the lows, and as I said, you've got to go back quite some time. So if we've got the last time we were at this level was back here in 2009, 2010. So particularly bad signs there for gold. Let's just have a look at the gold stock index. And you can see a terrible day on Friday. It really let go. It had broken support. This is the HUI index. It had found a little bit of support here, bounced for 2 days, and then just completely fell apart and had an absolute shocker on Friday. It's well oversold now. We may get a little bit of a short-term bounce, but we've now broken this key support level, which was formed in October of 2008. And we've got to go back a long time. We've got to go all the way back here to 2003 to find gold stocks down at this level. So 12-year lows. So not good at all for gold. Moving on to other commodities, copper edged a bit lower again, down to $2.48, and that's really just an ongoing confirmation of fairly weak global growth. Crude oil was down to $51. So when it was trading up around 65, I said it will come back, and it has. And the price action remains quite bearish, and also the fundamentals remain quite bearish as well. This is the spot copper chart. So just down under 250, but clearly still in a fairly decent downtrend. So just wrapping it all up, the only prudent approach for me is that you should own high quality assets which can be bought below fair value. And now I still get questions from lots of people about stocks they own, and generally a lot of them are not what I would regard as high quality stocks, and a lot of them are overvalued, particularly if they're in Australia. I'd really look critically, if you're not a member of Specialist Share Education, really look critically at what you own. If you're not sure what constitutes a high quality stock and where fair value is, then you may need some assistance and input on that. But this is a sort of environment where you don't want to be owning rubbish, because you could end up losing most of your money on those sort of stocks. The other aspect is, don't just be reliant on capital growth to do the work for you. There are other alternatives that you can blend into that overall investing approach that can really give you, a good underpinning to your returns. So expect ongoing volatility. I think that's the message. I don't see any great change there. I don't see a particularly negative market being established. I still have pretty positive signs, particularly for America, but you can expect to see the fluctuations a lot more significant. So for anyone that's not a member of Specialist Share Education, there's my contact details. Always happy to talk. That's it for this week. Cheers.